G10 foreign exchange strategist at Macquarie Bank. David Forrester joins us now live from Singapore. And today we're seeing, of course, the euro falling, and it's falling for the first time in 3 days. What do you think has changed the sentiment? Is it the up-and-coming debt sales, particularly from the likes of Spain and Italy?
There is a little bit of nerves around the debt sales as well as the ECB tomorrow. The ECB may turn out to be less dovish than the market looks, but we also have to remember that we've got a few newswires out there talking about the amount of debt, Greek debt in particular, that hedge funds are starting to hold, and that could actually interfere with the private sector involvement that is being negotiated at the moment.
So clearly, Greece key in the minds of investors at the moment. Do you think, therefore, the market will push for bigger losses? Well, indeed, the European institutions will want more than, say, a 50% write-down, as that is currently on the agenda.
That's an interesting question. You have the IMF pushing for perhaps 75%. The deal on the table is currently 50%. But the issue of these hedge fund holders, as well as other independent holders of these Greek bonds, are that they're loaded up on March maturities, and they may actually want to hold these to maturity and try to avoid a haircut and get a payout. So it's the potential for a dragging out of these private sector involvement negotiations that is weighing on the euro at the moment.
And David, how about your outlook for Greece? Do you think actually they can make some of the spending cuts that are promised to actually get hold of that next portion of the bailout?
Well, we have to remember that we have a technocrat government in charge of Greece at the moment, so they can get the spending cuts out there and going. But at the same time, we've got to generate growth in Greece, and that's where we need these structural reforms. And going forward in Europe in general, we do need the growth in order to reduce debt burdens as a percent of GDP.
So, David, of course, we've got a lot of volatility and concerns out there. Of course, the ECB tomorrow, as you mentioned. Where, therefore, do you see the euro going over the next few days? And indeed, do you have a call on the euro for the year?
Well, for the next few days, we actually think that the euro's downside's a little bit extended, or overextended rather. On a fundamental basis, we think it's run ahead of relative interest rates, as well as just the general risk-on environment we have seen over the past couple of days. So a little bit higher, but we would be sellers of the euro, especially back up toward the 130 level against the US dollar, and also against commodity currencies such as the Aussie and Kiwi. Now, we do expect the euro to be the worst performing currency in the G10 in the coming year, because at the end of the day, we have to remember that we've got a balance of payments crisis within a fixed currency union. So that's going to keep a lot of pressure, or downward pressure, on the euro going forward.
So we could see yet more selling of the euro going forward. I really wanted to get on to that meeting in Beijing with Geithner, and it seems the US is still keen to see the yuan appreciate, as it does believe, of course, it's undervalued. But how likely do you think China is to show any sort of flexibility on this?
Well, with current policymakers in China, the priorities are controlling local inflation, generating a soft landing in their economy, and pretty low on the agenda is their currency policy, which they're quite happy with at the moment. And they would especially be quite happy with the idea recently that they could have had a depreciation in the currency in this coming year. So it shows it's not a one-way bet in terms of it going up, the yuan constantly appreciating. So I think they're quite happy with their policy at the moment.
And of course, yesterday we saw that trade surplus remain relatively high in December for China, above expectations. But that, of course, is on the back of this slowing growth in imports. Do you therefore see potentially an easing of monetary policy in the future at China, and will this boost the currency?
Well, our house view is for at least one RRR cut in Q1. It could come in the coming days, depending on how those inflation data come out. The policymakers at the PBOC probably already have those inflation data, and if they're soft, we could see a RRR cut this week. Now, that would help generate that soft landing in the economy. Overall, we expect gradual appreciation in the yuan, and probably at a slower rate than in previous years, because we are seeing a bit of an easing in policy in China.
I see, so we could see a bit of stimulus in China, but how crucial is the US in terms of the economy seems to be showing signs of boosting. We've had labour market data better than estimated, and indeed in terms of business and consumer confidence. Is that pretty crucial for China in terms, and indeed Asian countries in terms of exports?
Well, the US is still a very important trading partner for China. At the end of the day, the largest export market is Europe, so a US that's recovering is going to be very important to help offset what is a very likely recession in Europe. So the US is very, very critical to China.
So all eyes on the US economic data in the future. David Forrester, G10 foreign exchange strategist at Macquarie Bank. Thank you very much for your insights and time today.